Hey, welcome to the Ultimate Wealth Podcast. This is the podcast dedicated to helping busy professionals and entrepreneurs achieve financial freedom and build a lasting legacy. I'm your host, Derek Pasalacqua, CEO and founder of Legacy Guard Financial Group and creator of the Infinite Wealth Blueprint. Each week, we bring you actionable insights, expert interviews, and real-life success stories to empower you on your journey to financial freedom. Whether you're looking to eliminate debt, grow your wealth, or secure your family's future, you're in the right place. Let's dive in and start building your legacy together today. So today, I want to talk to you about some of the questions that I oftentimes get when it comes to infinite banking. And a lot of these are the most common questions that we hear on a day in, day out, regular basis about what it is, how it works, is it too good to be true, how come I've never heard about it, how does my money continue to grow if I'm using it? And a lot of the common things that we hear are things we hear over and over and over again. And so we thought we would hop on, create a short recording, short little video, hop on this podcast and just discuss a few of the same ones that we hear most often. And for me, there's really 3 or 4 that really stand out as being the ones I hear most frequently. And those are, number 1 is definitely, okay, if it's so great, how come I've never heard about it? Number 2 for me is, how is it that if I borrow my money, how can my money be in 2 places at once? So how is it if I borrow my money, it can still continue to grow as if I never touched it? And I would say the third most common question that I get in terms of the infinite banking concept and using overfunded whole life insurance is definitely more around policy design and carrier. So I hear this all the time, is which carrier is the best and what policy design is the best. So it's kind of a 2-part question, but we're going to just bundle it together as one today because the answer, and I'll start there, is that that's a loaded question. There is no best carrier and there is no best design, okay? So to be clear, first and foremost, infinite banking is not a product, but rather a concept and an ideal that was designed to help us take back control of our finances and be more efficient with our dollars, putting those dollars to work. It's an alternative place to save and store capital. It is not an investment. And so therefore it should not be compared to other investments because that's just simply not an apples to apples fair comparison. They are very, very different things. Investment entails risk. This is no risk. Your money cannot ever be depleted in value. It's not linked to the markets whatsoever, unlike an IUL that uses call options. In the money call options, there is no indexing. There is either a guaranteed interest rate, or with all the carriers we use for the last 100 years or better, there has been a declared dividend. And that declared dividend has been all over the place, anywhere from as low as 5 to as high as 7 or 8 in the last 20 years. And that's another big misconception as well, but you don't get the interest rate and the dividend. The interest rate is your guaranteed bare minimum. So you're going to get that or the dividend. A lot of people think, and I hear a lot of TikTokers talking about, you get the interest rate plus an additional dividend, and that is not accurate. That's not how it works. You get either or. So when the company declares a dividend from when they turn a profit, like I said, all the mutually owned companies, there's really about 5 or 6 that we like to work with. All of them been in business more than 100 years, and not a single one has ever missed a dividend payment in that time frame. So although dividends are not guaranteed, when you look at an illustration, which by the way was never designed to show you a prediction of a likely outcome. It wasn't designed to predict what your policy was going to do. Illustrations are purely have always been, will always be for conceptualizing purposes only, to show you how the policy functions, and how it is credited interest, how it works, and just to show you kind of possible scenarios that could happen. So you can get a better idea and a better understanding of how the policy works, how it functions, and the interworkings of what makes it tick, what makes it go round. And that is it. It is completely pointless, in my opinion, to even look at an illustration out past 20 or 30 years. Completely pointless, because there's a million things that will change between now and then, and we have no control over pretty much any of them. So there are a few things that make this strategy extra special, one being the guarantees. So you know that no matter what, come hell or high water, you have a guaranteed minimum interest rate that your policy will be credited on an annual basis, no matter what, regardless of what the market does, regardless of what interest rates do, your policy will grow, period. Now, in addition, the more likely scenario, based on history, is that you're going to get whatever that company declares for their dividend. Like I said, I would say an average dividend right now is about 5.5%. Around 5.5%. But then this is another thing that's widely misrepresented, and that is that the policy charges, expenses, and all that still have to come out of that 5.5%. So that 5.5% is not a net. That 5.5% is a gross. So when you look over the lifetime of a well-designed policy, properly designed and engineered for use with infinite banking concept, you're going to be looking at a lifetime average IRR, which stands for internal rate of return, which is just cash on cash. That's how real estate investors look at investments. It's based on, hey, I have X expenses into this deal. I had this return, this, X amount returned to me, and this was the percentage. So basically you have your downs in a life insurance policy. You have your down years and you have your up years. And this is, if you could picture, kind of like if you drew a straight line that connected all the ups and downs, that balanced them out and put them at even. So from the beginning to the end of the thing, if you had to put it, so if, say, for early years, if you were like negative 20 or 30%, but then in the later years, you were maybe positive 40, 50, 60, where does that come to an even straight plane? And that's your IRR. And in a well-designed policy, you're going to be looking at an IRR anywhere between, I would say, 3 and 5. 3 being, honestly, probably where the majority of policies are at, maybe like a 3.2, 3.3. 5 being a little bit on the high side, maybe even stretching it a bit, but I have seen policies perform in that range. Certainly, it is not common, but it does happen. But as just a general average, I like to say between 3.5 and 4. I think that's a little bit safer and a little bit more realistic number. It depends on several variables, how efficient the company is, how the policy is designed, what the intended use is. So to get back to this first question, rather the third one, but we're kind of starting at number 3 and working our way to 1. So what is the best policy design and what is the best carrier to use? So like I said, loaded question. They're kind of a trick question even. My answer is always the exact same when I get that question, and that is, what are your goals? What is your outcome? And why is that important to you? So I'm a big believer of you must start with the end in mind. So what is your ideal outcome? What are you trying to achieve? What are you working towards? Let's start there. Let's get ultimate clarity on that. I want you to get crystal clear on what is it that you want and why do you want it? Why is that important to you? Once you know your outcome, it's just a simple equation. From there, we're going to reverse engineer back to what we need to do to hit that goal. So for example, let's say you want to supplement your income in retirement. This is one I hear all the time, and you have all these damn IUL agents online chirping about how the IUL is this magic bullet that's going to give you all this cash, tax-free income in retirement, yada, yada. And they fail to mention the part that, sure, it could work, but it could also backfire and be an absolute disaster. And for me personally, the whole point of insurance is to mitigate risk, not inject more of it. And so I would never use an IUL for income and retirement. I'm not saying they can't work. I'm not saying it's a bad product. I don't think there's anything wrong with it as a product. I do, however, think it is widely misrepresented in the industry as a whole. And I believe that AG49, AG49A, AG49B are all proof of that. They would not be trying to continuously regulate these things if they were not an issue. It's gotten out of control, to be honest, and it's turned into illustration warfare. But I'm not going to go down that road. I'm not going to get off on a tangent because I don't have the time. May never stop if I start. So to kind of rein it back in here, what is your goals? What are you trying to achieve? Once you know that, then it becomes, let's look at the facts. What's your income? What are your expenses? Okay, we have to have more money at the end of the month than we do month at the end of the money. All right, you shouldn't be, and this is very important. You shouldn't even be looking at this. You should not even be considering this if you are unable to even keep up with your current bills and obligations financially as it is. Period. This shouldn't even be a thought, because in order for this to be effective, again, this is just my opinion and nothing I say here is ever financial advice. It is purely for educational and entertainment purposes only. I like to be very clear about that. But you should be focused first on adding value to the environment and economy and society that you live in. You provide that value, you are compensated for such value. And then once your compensation and that cash flow, your income is steady and consistent to a level to where you can pay all your bills, you have 3 to 6 months of an emergency fund saved on hand. And I don't care if you put it in a savings account or money market or where it is, and you can even put it in a life insurance policy. But that's number one, because the way we like to do it is we like to tell people, whatever that number is for you, you figure that out. I'm not going to tell you what the number is. That's for you to decide. But somewhere between 3 to 6 months of living expenses saved and set aside. Okay. Once you have that number, now anything above and beyond that becomes opportunity. All right. So we never go below whatever that number is for us. Everything above that number is opportunity. So you're in a position when something happens, when there's a crash and everybody else is freaking out. Well, now you have cash on hand and you're in a position like nobody else is, which means you're able to take advantage of opportunities that nobody else can. And that's a super special place to be, because that's when you can make an exponential leap in net worth and overall wealth and well-being when it comes to your finances. Okay. So it's important to know you have to have some discipline. That's something I personally struggled with heavily early in my life, my career. Professionally speaking, I had zero discipline. I made a lot of money as a very young man, and I just, to be honest, I blew it all. I acted like a 21, 22-year-old kid that was getting paid too much money, because that's exactly what was happening. And regardless of what, advice or wisdom may have been or have tried to have been bestowed upon me, I wanted nothing to do with it. I was in my early 20s. I knew everything. If you didn't believe me, you could ask me and I'd have gladly told you. And so, I mean, sometimes we got to make our own mistakes. For me, I had to crash and burn for me to wake up. It's unfortunate, but I once heard Tony Robbins say that when you figure out how the worst day of your life was also the best day of your life, then your life will never be the same. And for the longest time, that never made much sense to me until it did one day. And then everything just kind of finally clicked. I understood what he meant and I could relate. And it was a humbling experience. I'm almost in a way grateful for it now. Not necessarily grateful for some of the side effects and the damage that maybe it created, but I'm very thankful for who I had to become, because it forced me to learn, it forced me to grow, and it forced me to become someone better than I was not before, because the person I was before had got me to where I was at. The person you are today has gotten you to where you're at. Okay, that same person is not going to get you to where you want to go. To get to where you want to go, you're going to have to become something and someone different. And if you've ever listened to Jim Rohn talk, you've likely heard him say many times that the value we get in becoming a millionaire isn't the money, but it's It's in the process of becoming a millionaire, of being someone who is a millionaire. It's who we become as a person. It's the type of character we have to build, the type of resolve you have to have, the way you have to think, the way your mind must work and function. That's where the true value is. Because once you know the formula, well, then it's just a matter of applying it. And you can apply that same formula as many times as you want. At the end of the day, a lot of times it's about just using leverage and smashing that leverage button and over and over until it breaks, rebuilding it and smashing it again and squeezing every last ounce you can out of it. But again, not to get off track here. So when we talk about policy design, the most common people we work with are typically people who make between $70,000 and $75,000 a year, 3 to 5 pieces of consumer debt, whether that be medical bills, back taxes, could be vehicle loans, credit card debt, could be student loans. Okay. It could be anything. It does not matter what it is. Our program, what we have people do is make their minimum payments. This is why it's so important that you're able to make your payments to begin with before even considering something like this. So you start to make your minimum payments, okay, towards all your debt, everything above your minimum. And we go through all your finances with a fine-tooth comb. We redirect all the inefficient dollars that are in your current financial budget into your new debt action plan. All right. So that begins to grow and compound over time. One of our favorite policy designs for this, because the whole point is early cash value. So if the point's early cash value, we want as much money going towards what's called the PUA rider, which is paid up additions, as much as possible. So if your monthly premium is $1,000, I know some people say, why in the hell would I ever pay $1,000 for the premium? I'll get to that here in a minute. But we want the smallest amount of that getting eaten up in cost, and we want the biggest amount of that going towards PUAs. PUAs are going to increase your death benefit because it's paid up additions. It's buying fully paid up pieces of whole life insurance, small chunks. Okay, so that's what increases your cash value as well as your death benefit. And so if you're making $1,000 payment, and I believe like one of the last clients I worked with, his was $1,200, and out of that $1,200, $1,100 of it pretty much, just to use even numbers, was going towards his PUA rider. All right. And so we like to do a 90-10 because the goal is get out of debt as quick as possible. So then we can redirect all that cash flow that's currently being eaten up each month by our debt obligations. And we can redirect that towards our opportunity fund and use it to build wealth. And that what will greatly expedite the wealth building process. So the goal is free that money up as soon as possible and then redirect it once freed up to start putting it to work and deploying it to start building us, acquiring cash, preferably to acquire cash flowing assets to start building our wealth and our net worth. All right. So, but you may have a different goal. Maybe you're already out of debt. And so maybe that doesn't apply to you. Well, in that case, maybe you have a lump sum and you want to front load your policy so you can just turn around and pull it right back out and put it in a real estate deal. We have clients that do that. People say, why would they put it in whole life first and turn around and pull it out? Well, that's simple because of something called opportunity cost. So one of the first principles that R. Nelson Nash teaches in his book, Becoming Your Own Banker, is something called opportunity cost. And he says this in the book. He says, and I may be butchering this, but something along these lines, says the very first thing that one must understand for practicing this is that we finance everything we buy. We either pay interest to someone, like a bank or credit card company, or we give up the ability to earn interest on the money that we used. So we either pay interest or we give up the ability to earn interest. That's opportunity cost. So when you spend $1, you don't just lose that dollar. Okay. You lose that dollar and everything that dollar could have earned you for the rest of your life. So if you go to the store and you pay cash for something, here you think you did good, but maybe that same vehicle you just paid $20,000 cash for, maybe you could have got a loan for that at 2.5%. Now, let me ask you a question. Do you think that you could go do better than 2.5%? Because that's what cost of capital was. Do you think you could have took that money and gotten more than 2.5% somewhere? I'm going to say yes, because I know for a fact you can. You could do it in a whole life policy. And that's exactly why somebody would do it. So, and now again, I'm never, let me be very, very clear. I am not a fan now, in the past nor in the future ever will I be a fan of using your policy to go buy depreciating liabilities rather. I'm a fan of using your policy, leveraging your dollars, putting them to work at more than one place at a time to acquire cash flowing assets to build long-term net worth and wealth. Okay, so the way that works, to get into question number 2, and as far as the best carrier, it doesn't really matter. I mean, who's the best home builder? It just depends on several factors. Now, I will say this: if you're going to front load your policy, Lafayette Life is hard to beat. But on the flip side of that coin, they also have the worst underwriting in the industry, meaning these policies you have to get approved for. So when we talk about pros and cons of infinite banking, one of the biggest cons of this entire strategy is the fact that you have to be healthy enough to be able to get approved. Now, I will say, if you're not, that's not the end of the world, because as long as you have insurable interest in someone else, you can still do this. The death benefit and the policy would be on someone you have insurable interest in, a family member, like a brother, sister, a child, grandchild, something of that nature. You would own and control it, but the death benefit would be on them. And there's people that do that all the time. So you do have options if you can't get approved, but it's just not going to cover your life. So when you pass away, that death benefit isn't going to be passed on tax-free to your family like it would be if you were healthy enough to get the policy on yourself. But again, depending on why you want the policy in the first place, what your goals are, there's a infinite number of factors that kind of plays into what's important to you and why. So anyways, as far as outside of front loading, there's Lafayette Life, there's Foresters, there's One America, there's Ameritas, there's Mutual Trust, there's Penn Mutual, there's Mass Mutual, there's Guardian, there's Northwestern, and New York Life. Those are pretty much the 10 or so companies that you can do infinite banking with. Outside of that, I wouldn't use any company outside of those ones I just named. Personally, that doesn't mean that doesn't mean you can't use any other companies. You certainly could. Those are just the ones that we prefer to work with, simply because they have a track record and a history of good performance. And some of those have changed. Some are better than others. Again, it just really depends on the scenario. But I'll say this: if you go with any of those companies, you're doing fine. There's not going to be a huge difference. So as long as you're with any of those, you're going to be doing just fine. Okay. Now, to get back to the other question, what you really want to look at whenever you're starting one of these is how much can you comfortably contribute, because one of the downsides is that you are required to make a monthly premium. So there's a ceiling and a floor. So these are flexible. They do have some flexibility, okay, versus your traditional whole life policy where there's just a set premium and that's it. It's pure death benefit and that's what you're required to pay. It is what it is. With these policies, you may have like a maximum you can put in a year up to 50,000, and then there may be a minimum that's required of say 5,000. Okay, there can be a lot of variance in there, but you want to put as much as you possibly can in the early years to get the thing funded, get it capitalized, and that's what's going to yield you the greatest result and the greatest return on your money. But the reason it's able to continue to grow, even when you're using the money, is because you're not using your money. You're using the insurance carrier's money. Okay, so when you take a loan from your policy, now I will say this real quick, is life insurance, one of the cool things about it is FIFO, so first in, first out, versus where like a 401k, for example, is LIFO, last in, first out. Meaning with life insurance, last in, first out. So you can draw your money that you've put in, your contribution, tax-free out. But I wouldn't necessarily do, there's certain scenarios where that can make sense, but just in general, most of the time, most people are going to use a policy loan. Okay, so the way a policy loan works is you're going to take a loan from the insurance carrier, from their general fund, all right, and then your money is going to continue to grow inside your policy as if you never touched it, because you never did touch it. You borrowed the insurance company's money and they used your cash value, okay, they collateralized it, used it as a collateral, and you're basically borrowing your future death benefit. So collateralizing your cash value and borrowing your future death benefit, because it's a unilateral contract and they're on the hook for it either way. They're going to get paid back either way. So The loans, when you take them, there is no structured paybacks. Payments aren't required, although I would highly always recommend you pay your policy loans back and be an honest banker, because if you don't, the interest can compound against you, and depending on circumstances, it could be a disaster. So I would always highly encourage you to do that, but you do not have to. And for real estate investors, one of the cool things about it is that, say you're waiting on a policy or on a property to sell, so you could use the money for a renovation, use it for a down payment, and then wait however long you need to, 6 months, 8 months, a year, whatever it takes. When that place sells and you get your big payout, then you can just take and go pay that off. And then it works just kind of like a HELOC or a line of credit. And as you pay your loan back, that amount then becomes available for you to borrow again in the future. But all the while, your policy continued to grow and compound. So you're not just back to where you were when you borrowed, you're actually further ahead because you never touched your money and it continued growing. So those are some of the common questions we get when it comes to infinite banking and whole life insurance. I just want to hop on here today to touch on a few of those. We're going to do a part 2 of this next week. So I'll just kind of leave it at that today. I'm not going to go a lot further. If you're interested, if you'd like to learn more about how this could work in your life and in your finances, I want you to feel free to come check us out at mydebtfreeadvantage.com. Again, that's mydebtfreeadvantage.com. That is our main website that talks about how we can help you eliminate debt while building wealth without increasing your income, adding to your expenses, or changing your lifestyle. So we encourage you. We've got a lot of good information on that site. You can go check it out. We also have our membership site at ultimateacceleratorblueprint.com. Again, that's ultimateacceleratorblueprint.com. And that is our membership site. We have a free community on there, ton of free resources, resource vault, all kinds of good stuff. You can 14-day free trial. If you want to check that out, go do that and see what you think. If you like it, great. If you don't, that's okay too. You can cancel. No hard feelings either way. And then last but not least, we have our newest community. It's kind of a content library where we just have a ton of courses, resources, and learning materials. We do webinars every week, do a lot of masterclass learning, just teaching people about the concept and how they can use it and implement it in their lives and finances. You can check that out at MVT. That's M as in mother, V as in Victor, and T as in Tom, .so. ultimatewealth.mvt.so. All right. And if you want to find us anywhere else, you can find us on all the social media channels at Life Pros Academy or Legacy Life Pros, and our YouTube channel, Ultimate Wealth. So I appreciate you taking the time out of your day to join me today and listen. If you're still stuck with us this whole time, thank you. It means a lot. We do greatly appreciate it. Again, my name is Derek Pasalakwa. I'm with Legacy Guard Financial Group. And until next time, remember to live your legacy.